Hey everyone, Todd Martin here from Mission 35 Mortgages. Welcome back to First Home Simplified. Each Wednesday, we break down one key part of the home buying process to help you buy smarter and stress less. Last week, we talked about what a mortgage broker really does and how we find solutions the banks can't. This week, we're getting into one of the biggest questions every buyer asks. How much do I actually need for a down payment? Most people think you need 20% down to buy a home. It's one of the biggest myths I hear. The truth is, in Canada, the minimum down payment starts at 5%, not 20. Here's how it really works. For homes up to 500,000, you need 5% down. For the portion between 500,000 and for first-time home buyers, 1.5 million, it's 10%. For everybody else, it's between 500 and 1 million. Once you hit over 1.5 million, that's where you need 20%. So if you're looking at, say, a $650,000 home, your minimum down payment isn't 130,000. It is roughly 40,000. What it is it's 25,000 for that first 500, 5%, and then 10% for the next 150,000. So 25 plus 15, $40,000. That's a massive difference, and it can mean the difference between waiting 2 years or buying this year, buying right now. Now let's talk about when you do need that full 20%. You'll need 20% down if the home price is more than 1 million or more, 1 million or more. CMHC insurance isn't available above that limit. For a first-time home buyer like yourselves, you're exempted up to 1.5 million. If you're buying a rental or an investment property, so if you're buying a secondary property or if you're purely rental, those can't be insured. So lenders require a 20% down payment. If you're looking at a private or an unconventional property like a mixed-use commercial, say a convenience store with an apartment above it, or something that doesn't meet standard guidelines, most of those require you to put down 20%. Sometimes you might also choose to put 20% down even when you don't have to. For example, if you want to avoid mortgage insurance premiums or if you're trying to keep your payments lower. But for most first-time home buyers, that 5 to 10% range is all you need to get started. Next question. Does that money all have to be from your own savings? Not necessarily. There are three main ways you can come up with your own down payment: personal savings, RSPs, TFSAs, regular savings accounts, so any of your own personal savings, right? Gifted funds. This is becoming more and more popular, especially in today's market. Any immediate family member, parents, sister, brothers, so siblings or children. I'm actually doing one right now where their parent or their son is gifting them money to help finish the deal. Borrowed funds. This doesn't mean funds you're borrowing from a friend to repay. This means money you're using from your own lines of credit, something like along those lines, or a loan. As long as the ratios still line up, as long as the numbers still work, you can use money from a line of credit. That's the most common thing to use it for, right? Or you can do an RSP loan, something along those lines. That works too. Here's a bonus. If you've been contributing to your RSP, you can use up to $35,000 per person through the home buyer's plan, tax-free for your first home. But be aware, you have to pay that back within 15 years. If you're a couple, that's up to $70,000 per year that you can access tax-free. If you're using the first home savings plan, you can use up to 40, and you do not have to pay it back. You can also transfer money from your RSPs into your first home savings plan, 100% tax-free. The key is documenting where it came from and showing a 90-day history, which I'll walk through when we do your pre-approval. A lot of buyers save just enough for the down payment, but forget about the other costs that come with buying. Things like closing costs, usually between 1.5% and 2% of the purchase price. As a first-time home buyer, it is generally 1.5%, because the key here is you get a lot of little breaks as a first-time home buyer. So you will see a $4,000 break on your land transfer taxes. You'll get some money back on your taxes on your next tax year. So there are some breaks where that 2% will actually drop to 1.5%. Um, then what's included in your closing costs? Your appraisal fees, your lawyer fees, home inspections, land transfer taxes, title fees, title insurance, all that kind of stuff is all included in your closing costs. So let's say you're buying a $600,000 home. That means you're budgeting for an extra $9,000 to $12,000 for closing costs. You don't want to come up short right before closing day. So you want to budget for this all at the same time. So your down payment, when I go through an application and a program and a first time home buyer plan with somebody, I include everything. I let you know this is what your down payment needs to be, and you have to prepare for your closing costs because that's all part of the deal. You have to prove it. You have to show that you have the ability to pay it. So let's make it real. What you're looking at. So let's pull something up. I want to share something with you. Let's share it. The right one? That's the right one. So this is simple $500,000 purchase. Okay, you get your minimum down payment is 5%. That's $25,000. These are roughly what your closing costs are going to be if I move this over here. Okay. Um, scroll this down, scroll down, scroll down. So you're looking at land transfer. This is all based on first time home buyers. Okay. We can throw property taxes in there in Hamilton. If you're $500,000, you're probably looking at $4,000 a month for property taxes. It's really not going to change much on this stuff. Okay. So your monthly um, or your closing costs for this, you're looking at roughly $1,700 in legal fees, $500 for appraisal, PST on the mortgage, insurance, and land transfer test. That's a rough breakdown. It's not exactly everything. Your legal team will break it all down for you. If you go back over to the mortgage, it tells you what your mortgage payment will be is just under $3,000 for this is a 5-year mortgage. Um, so I mean, that's pretty basic breakdown. At five, I mean, we're not going to put it at 5 point rates right now. We're about 4.19 for 5 years. Pretty basic right now. So $2,600. So if we want to do something a little bit different to show you, so say you want to do 700,000, $700,000 purchase. That means again, 25,000 for the first five. And then 10% for the 200,000 above that means your down payment is now going to be minimum 45,000. From there, your closing costs are now 10,971. Your land transfer taxes are going to be 6,500. Your PST on the mortgage insurance is going to be 2,000. Your legal fees are going to stay the same. Your appraisal is going to stay the same. And your mortgage payment is going to be about $3,600. So, and I just want to show you one more thing as we do this. If you put down 10%, so let's say you put down, if you have it, 70,000. What does that do? It drops your mortgage payment down to 3,500. It does not change the closing costs because those are all set numbers. Um, one more thing. I know you don't have to put down 20%. I just want to show you the difference because so what happens with an insured purchase is the bank will automatically insure the mortgage on your behalf and they will put the fees on the mortgage. So you buy a $700,000 mortgage or you buy $700,000 purchase, you put $40,000 on it, $45,000 on it. You will then see $25,000 to $30,000 put back onto the mortgage in insurance. So if we were to do that and put 140,000, that's 20% down. Your rates are going to be better, are going to be a little bit higher because there's not insured anymore. So right now, insured rates are say 4.34%. Right. But now you're paying less. Your payment has dropped to $3,000 a month. I just wanted to show you the difference. So, I mean, I wanna take off share screen. I know it's all a little complicated in how down payments work. Um, this is why conversations happen. So, um, this gives you an idea of what your money can do if we structure it properly. Remember, it's not just about having the money, it's about how you present it to the lender. Here's a takeaway. You don't need 20% down to buy a home. You just need a plan and a broker who knows how to make your situation work. If you're serious about buying your first home, start with a strategy call. We'll run your numbers, look at your down payment options, and build a custom roadmap to ownership. I want you to understand I've helped 5 or 6 people in the last 2 years go from nothing to owning their first home. No down payment, no idea how to do it. I love helping people walk through this. Okay. Next Wednesday, we'll be live again, 7 p.m. with a mortgage stress test and how it affects you, explaining it, why it matters. You don't want to miss that one. It's the key to understanding how lenders decide if you qualify or not. So book your free time anytime at toddmartinmortgages.ca. Don't forget to subscribe at youtube.com, hashtag at mission 35 Todd. Cheers. See you guys next weekend or next week.